Good morning, everyone, and welcome. To kick off, we've got a really super panel here that I want to introduce and then get them talking about what they see as the future of energy investing in our modern world, which is obviously a number of key factors, both secular and cyclical, as the panel is talking about coming into this. Hopefully we're going to do well in this virtual environment. We've got obviously 5 of us all connecting together here, and hope technically it goes well for everyone. So to kick off, I'd like to introduce the panelists. Mark Florian, Head of Global Energy and Power at BlackRock. John Moon, Head of Morgan Stanley Energy Partners. Adam Watrous, Managing Partner of Watrous Energy Fund. And Evan Corley, Partner at the Global Infrastructure team of Pantheon. And to kick off, I want to ask each of you to introduce briefly your strategy and how you engage in the market, so everyone has context when we get into the questions. So perhaps, Mark, you can take the lead.
Thanks so much, and welcome everybody to our panel. I'm Mark Florian. I lead for BlackRock our global energy and power infrastructure funds. We have about $9 billion under management that invests in equity in energy infrastructure around the world. It's a global strategy. We invest in renewable, but also some conventional power, in midstream and utilities, and other energy sustainability businesses as well, across about 35 to 40 portfolio companies to date. So that's a little bit about our business. Thank you.
Great. John, do you want to go next?
Yes, thank you. And good morning or good afternoon or even good evening, depending on where you are. I'm John Moon. I head what is internal to Morgan Stanley known as Morgan Stanley Energy Partners. We're the energy private equity fund of Morgan Stanley, the global investment bank. We've been in business for over 20 years now. And we are a North American middle market energy buyout fund. And the operative term there, I think, is a buyout fund. We have historically been a later stage investor. We haven't been involved as much with oil and gas startups, although being an energy investor, much of what we do, I would say the majority of what we do is involved with oil and gas. A lot of what we do historically has also been outside of the oil and gas industry. We were doing batteries before batteries were cool. We were doing biofuels before biofuels were cool. Going back, way back when we even have done some hydro. But like I said, the majority of what we do is traditional oil and gas in the later stage investment format. In theory, the mandate is global, but we really do focus on North America, and even within North America, Canada and the United States.
Right. Adam?
Hi, so I'm Adam Watrous. I run a firm called Watrous Energy Fund. We are what is called now, I guess, a traditional oil energy investors. We're in the oil and gas sector, but we're not investing it in a traditional manner. The traditional private equity model, as John was alluding to, it tends to be our early stage, backed strong technical teams to de-risk tier 2, tier 3 assets, build up companies, sell them. It's a venture capital model. So that's not what we're doing. We are approaching the business from an operating company perspective, buying established businesses that can be consolidated into a single operating platform, and importantly, focusing on free cash flow to be able to provide liquidity to our investors. We have about $2.5 billion under management, started about just over 4 years ago. And we have a single operating platform called Strathcona Resources, which is something north of 80,000 barrels a day now, which is the largest private oil company in North America.
Cool. And last but not least, Evan.
Hi, good morning from California. My name's Evan Corley, and I'm a partner on the infrastructure and real assets team at Pantheon. Just to give some context around who we are a primary, secondary, and co-investor across infrastructure and real assets. My team today manages about $16 billion, of which a healthy proportion is energy broadly. And I would say that that really spans the entire energy value chain, including upstream, midstream, downstream, conventional power, renewables, and everything else I think you can think of at this point in time. So that's just a little bit of context around who we are and what we do.
Fantastic. I think we've got a really good panel with different perspectives here to bring to the table. To kick off, I did at CEPRES, we help LPs and GPs on underwriting investments that they make, both fund and direct investments. So I had a quick look at what data we had on the market, and we see a lot of the activity going on. And what we've seen since about 2016 is quite a significant growth in alternative energy, and especially in net distributions, positive net distributions versus traditional. And I think that's part of the juxtaposition of the market that we're in now, is that transitional phase. So with that, maybe Evan, as a mixed investor, as you talked about, could you talk about where you see capital flows from LPs over the recent times and what you see going forward in the US and European markets, and how you see that playing out between alternative and traditional energy of the capital flowing?
Yeah, Chris, I think you hit on a really operative statement related to just kind of where we've been seeing it as well. I think just generally, I can say that there's a pretty big difference between European LP demand, and I should actually really kind of group that together with other regions around the world, and North American demand from an LP perspective. Easily within North America, I think over the last 2, 3, 4 years, we've seen a pretty significant decrease in demand and interest in traditional energy strategies. But I think there's always been an underpinning base of investors interested in investing across the entire energy value chain. And clearly, I'm thinking a lot about upstream energy, where historically it's been a big part of the North American LP appetite, and it's declined. And the big question is, where does it go from here? In Europe, I think there's been a long-standing ESG consideration around some of the traditional power sources. So we've seen less demand in that area. And that's certainly a trend that I expect to continue. Looking forward, just over the next couple of years, I think we're going to see an interesting bifurcation of the market. Over the last year or two, I think many have used oil volatility to effectively reset their investment policy in some of the key kind of endowments, foundations in the US. But I do think that given the dearth of capital being deployed in the area, that you're probably going to see some interesting returns. And I think that actually will spur some new capital flowing into this area. But at the same time, I think that a lot have created policies around alternative energy and energy transition, which they're really using to probably avoid that area over a long term. So that probably takes a fair amount of the capital out of the area. And I think it's kind of status quo in Europe. They're going to continue focusing on energy transition and new energy alternatives.
Thanks. John, is that in line with your thinking? Do you see the same patterns across US and Europe? And maybe you can also reference to what you're seeing in Asia.
So I would overall agree with Evan in terms of the current state of play. If you look at Europe, the North America, the United States, and Asia, one of the things I like to do is try to speak at or participate in one of these conferences to those continents at least once a year, because the contrasts historically have been quite striking. Europe has clearly been at the forefront of the ESG movement, the environment, in particular climate change and CO2 emissions. The United States has been somewhere in between, and Asia up until very recently, although, you know, when Asians tend to investors get on board in something, they tend to really dig in and make a strong go of things. But historically, anyway, Asia had been slow to the ESG initiatives. So I think that's true, but certainly the trend, whether you're in Europe, North America, or Asia, or anywhere else in the world for that matter, is going to be more towards energy transition. In my mind, the question is, not the general direction, but the degree to which any given investor is going to move in that direction.
And do you see particular, John, on that following up, just do you see particular strong patterns in locally in the US, in North America versus more secular, if you like, in Europe?
Well, what I would say is in the United States, as Evan mentioned, there's been a bifurcation even in the United States. I think if you look at some of the public pension funds, they tend to be leading on this and tend to take a more, and I don't mean this disparagingly, but an just view, which is to sort of say they really are, they feel very strongly that they should be investing in renewables at the expense of traditional energy. Whereas some of the more mid-cap institutions, if you will, the insurance companies, the endowments, have been, while again, the trend has been towards cleaner and greener, tend to be a bit more in their strategies.
So it's whether you're driven by returns or by principle in a way of future direction. Mark, maybe you can comment also on that
option as well.
Say again, John?
Yeah, what I would say is, look, there's a lot of capital facing clean energy now, up and down the chain, whether it's utility scale, solar and wind, all the way down to tech. And so that makes it very challenging as an investor trying to earn an attractive risk-adjusted rate of return, because there is a decent amount of money there that really is looking to deploy almost, I mean, with certainly a high priority placed on that strategy, where returns might be never explicitly, but returns may be secondary to the important consideration of just deploying capital in that space.
Yeah. Mark, for BlackRock, is that a key factor for you? Are you finding for your own strategy, your investors, are they typically more return driven, or do principles in ESG overlay everything now, and that you might have to turn down good investment opportunities just because they're not environmentally or governance friendly?
No, it's a great question and one we grapple with. I'd say it's been interesting because we've had a number of ESG principles embedded in our investment process for 10 plus years. We just didn't necessarily call it ESG. We've thought about environmental issues. We thought about worker safety, social governance, being a good neighbor in the communities in which we work. So those elements have always been part of our underwriting. And if we can't get satisfied on those elements, then we're not going to do the investment. But I would say over the last few years, and BlackRock's been very vocal about this, sustainability is incredibly important. And so what we've done is we've gone back and we've looked at all of our underwriting processes to make sure we're fully embedding ESG principles into every step of our investment process and as a very important consideration. And sometimes that weeds out good investments because we don't think they're doing the right thing. But in the end of the day, our investors want the risk adjusted returns that we're shooting for, and that is a key element. So I'd say ESG is a very element of making an investment decision, but it isn't the investment decision. The one thing I would maybe add too is that as the market's changed, and we're talking about, there's already been some good discussion about conventional versus renewable. We haven't necessarily said that conventional, and we've been a decent sized investor in natural gas because we think it is a transition fuel that's going to be important to getting us to net zero and a cleaner future. We've taken a much more careful view about what is the long term for traditional infrastructure that's associated with conventional energy. So I'll give you an example. For oil related infrastructure, it's unclear when we might hit peak oil demand. And so if we're investing for a 12 or 15 year period, we need to really think about what's going to be the terminal value of an oil pipeline system that we may own. And so I think we're taking a much more conservative, careful view on terminal values of assets like that, just because the market is changing so rapidly. And given the pandemic, we think it's changing even more rapidly than before. So, so I think our underwriting standards and approach have gotten more conservative with regard to many areas of conventional energy, and that's impacting, values in the end of the day.
Yeah, and I guess that's core to the title of the panel, secular versus cyclical. So it sounds like you've got a secular overview on the whole market, whilst you might be chasing returns for a more shorter period. Adam,
it's a challenge.
Yeah, it's an interesting time we're in for everyone, I think, in every case. It kind of brings us to you, Adam, because you're in a way a unique person on the panel as a pure traditional energy investor. Are you seeing this shift and transition and secular shift as a market opportunity or a curse for you that's holding you back, or is it actually helping you to be more successful as an investment firm?
So we look at it a bunch of different ways. The most obvious is if you're in the hydrocarbon business, you need to be on a never-ending journey to decarbonizing your business. And what do you mean by decarbonizing it? The number of kilograms per barrel produced, continuing to focus on how to reduce that, will be a very long journey. And how we think about that directly. Our portfolio has produces about 39 kilograms per barrel produced. That's relative, say, U.S. average is about 66. So, how we think about it as an investor is are our barrels being produced, crowding out more carbon-intensive barrels, and how are we bringing that down over time? And I would just, as a quick editorialization, I'd say that generally Canada is quite far in advance of the United States. Canada's been on that journey for a long time. The Canadian carbon intensity per barrel is down about 20-25% over the last 10 years. U.S. really hasn't moved at all in that time. So the first thing I think about is you got to be focusing on, you got to making investments, got to reduce the carbon intensity because you want to be far better than average. That's the first thought. My second thought, though, is going back to maybe a comment that Evan made. He made it very politely, saying, "Well, oil volatilities, has led some people maybe to think about." Well, actually, what happened is, if you're investing in the E&P sector in the last 10 years, you generally got your face ripped off. It was a disaster, and those horribly low returns that were earned by investing in basically the last 7 years, very specifically, 2-3% rates of return, have led to a lot of people exit the sector, understandably, when the returns have been that bad. And on the way out the door, they've checked the ESG box by saying, I'm not going to invest in fossil fuels anymore. And I've seen this in a lot of European discussions because my returns were so bad to begin with, and I might as well be able to now say, okay, I'm not going to participate in that anymore, which is frankly very understandable and logical. Which really brings to the opportunity is if you do some math on what's the long-term oil demand. There's a lot of different forecasts on what long-term oil demand might be, and what your investment horizon might be. Does that create an opportunity? And one of the things that I've got one of my boys just finished. One of my sons just finished college, and he was at there was a little protest at his college to get the endowment to divest out of fossil fuels. And there were all these kids, with placards, saying, "Hey, you got to divest, got to divest." And one of the kids has a photograph of this. One of the kids says, endowment, divest out of fossil fuels, on the top half of the placard, and the bottom half says, My dad likes to buy his stocks cheap. Now, I think that's quite a revealing event, in that fundamentally, if you think that oil is going to continue, hydrocarbons are going to be part of the energy mix over the next 20, 30, 40 years, what kind of hydrocarbons to own? And I'm saying that should be ones that are accretive in terms of the decarbonization of the world, lower than average. And the fact that capital has left the sector, I think that's check mark. That's a positive, meaning the reason returns were so poor is that the industry got grossly overcapitalized. There was way too much money in the traditional E&P sector. And so this is a healthy process of investors leaving the sector, which should allow more attractive returns to return.
So you see, it sounds like what you're seeing is, the question is a timeline, but a cyclical trend where there's an opportunity in traditional energy. The question becomes whether or not the actual investor wants to jump back into that. But I think as John was alluding earlier, there's a mid-market that definitely do want those returns. So there's a cyclical opportunity, but you're on board with the secular trend. The question becomes time frame. So it's interesting, maybe go back to Mark there. You were talking about a 15-year type of horizon, and Adam's kind of alluding to a 30 to 40-year horizon. Are we somewhere between that, or do you think the world is going to change much quicker and that transition phase and that cyclical opportunity is going to be more short-lived? And what does that mean to an investor today? Because I think part about it, this hopefully we'll get, is some thoughts for investors. Where should I be looking for my short, medium, and long-term investment opportunities? Do you want to comment?
Sure. I don't think we have the crystal ball in terms of exactly when these curves are going to change significantly. You know, the fact of the matter is that much of the world still runs on conventional energy today. We know that's changing, and but when is it going to actually reduce substantially demand for oil, demand for natural gas? Or, you know, it's happening already in coal, as we all know. So, you know, the question is, how do you protect yourself? How do you build a moat around your investment to ensure that you don't get hurt if you're going to invest in those areas? And, you know, thought about is really, you know, we're in a world with infrastructure where we typically have revenues that are supported by contracts from counterparties. And so we think about those contracts and the counterparties, and will those be viable over the near to long term? And often those, you know, average contract length for a lot of what we do is 8 to 15 years. But the challenge is thinking what happens after that contract is gone, and you need somebody else to sign up to use your infrastructure. What is the value of it? Can you recontract it at all, or will it be at a lower value that might impact? So the way we've thought about that is, in the short and intermediate term, we're going to rely on the cash flows we can get on these businesses in that period of time. But if we're relying on some thesis in terms of what the market's going to look like in 15 or 20 years for conventional assets, and that's the majority of how we get our capital back and a return on our capital, then that's probably not an investment we're going to do. We're going to be focused on a lot of cash flow early and often, and to de-risk essentially, you know, what happens in the macro longer term.
John, do you want to come in on this theme?
Yeah. Well, I think one of my sayings when it comes to energy investing, at least at the moment, is, as Adam has pointed out, let's not confuse the cyclical with the secular. My other favorite is, let's not make the good the enemy of the great. In other words, I think where some of the most interesting opportunities lie are not necessarily with the cleanest zero carbon investments where you've got all of that capital aggregating. It's the conscience capital, if you will. It's the, look, don't embarrass me. I want this money invested. I don't want you to embarrass me, but I am looking, whether they say that explicitly or not but that's what they're thinking. And then you've got others who are sort of, still in the old traditional mode. It's interesting that liminal space in between, where everyone, and even in Paul, for example, sees to move the ball forward, right? Make gains with regard to decrease. So where does that lie? Well, half of carbon emissions, but only the way, come from the oil and gas industry, right? So reduce scope 1, scope 2, scope 3 emissions in energy. We're working on ways to replace diesel with natural gas. By the way, natural gas pathway, there's a road to ultimately get to hydrogen, and in theory, green hydrogen. So I think some of those pathways, we think our investment horizon is being one measured in decades. Any given investment that we look at as being a 3 to 7 year investment, we're looking down the road, and what we see are a number of really interesting pathways that don't make the enemy the great the enemy of the good, the enemy of the great. And we're going to be in energy transition as it relates to the areas we think is frankly most interesting.
So it's still walking the line between returns and secular shifts in the market. And Evan, is it the same for you? Are you guys doubling down on alternative type of opportunities, or are you still keeping, seeking shorter term returns from traditional energy opportunities, or like John, somewhere in the middle?
I'd say like John and Mark really alluded to some of this as well. I think that we've been, we certainly have an eye on renewables and alternatives, and kind of how this market is evolving with regards to how we think about the opportunity set and what we're looking for. We absolutely do want to see strong contract protections. We're looking for investment returns to come from some of that, just as Mark was talking about. But you have to keep an eye on terminal value and implications for, what will happen to your investments when you actually ultimately divest those interests down the road. We are subject to our own LP demand, which I should absolutely comment on, because we have seen that shift that I was alluding to earlier in the conversation, where there's just less interest in conventional energy sources, and we have to be responsive to our investors on that front. With that said, we do see an opportunity set in some of the traditional energy, conventional energy strategies, particularly on the secondary market. And I appreciate that not everyone here is involved in that area. But with the divestment that many of these institutions are going through on the ESG side, you're seeing some pretty interesting pricing for strategies there. And so we have been looking into that market to see if there might be some interesting risk-adjusted ways to enter that area, in that space.
So you're being opportunistic, following the major trends, but being opportunistic into opportunities in the market. I think Adam was alluding to that a little bit as well. There are opportunities for returns as that secular shift takes place. Maybe we're coming down to 10, 12 minutes now. I think it'd be good opportunity maybe for each of you, and we can start with Mark, whether it's in the context of direct ESG investing or other opportunities you see in the market, where should investors be looking for interesting opportunities to take them forward? Energy is never going to be a short-term investment anyway, but maybe medium to long-term. Where can you see a point, and what would you say to your investors? Look, this is interesting areas, so that we leave people with some thoughts. Mark, do you want to go first?
Sure. Thanks, Chris. There's a bunch of areas we think are emerging that traditionally have been more in the venture capital or maybe early stage private equity that we think are coming towards more for our funds and infrastructure like risk profile. And there's 5 areas, some of which that are more developed like that and some less, that we're really focused on. And those include things like carbon capture, EV and EV charging infrastructure, sustainable fuels, including hydrogen, and a couple of other. Energy efficiency is another. So maybe I can give you two quick examples of investments we've recently made along these lines. We took private a company called Callison. It was a $3 billion take private enterprise value. Callison is in the energy efficiency space because it installs and maintains smart meters across the UK. The UK government said every building basically in the UK needs to have smart meters for both electricity and natural gas. If you have better information, you typically cut your energy consumption. That creates efficiency and obviously a cleaner system. So Callison gets paid a 15-year revenue stream for every smart meter that's installed. And so we have a nice revenue stream. We can have nice stable returns. It's a growth business in terms of the installation of these smart meters. And it is energy efficiency. So that's a business model that works for us that really didn't exist 5 years ago. Maybe one other quick example. We announced about 2 months ago a joint venture with Valero, which is a big refiner in the United States. They produce a lot of ethanol that we all use in our gasoline in the United States. Ethanol, a direct output of producing ethanol from corn, basically, is CO2. So this project actually takes all the CO2 from all their ethanol plants across the Midwest, moves them to a receipt point, the CO2 to a receipt point in Illinois where it can be sequestered in caverns permanently. This isn't enhanced oil recovery or anything else like that. The interesting thing to us is that in looking at the federal tax credits and the tax credits that they can get from various states from having low carbon fuels, the economics of this actually work incredibly well. So we're working on this project. We hope to have shovels in the ground next year for what will be over 1,000-mile pipeline system to enable this. So I do think some of these areas are emerging.
No, good secondary investing examples for energy. Evan, any thoughts from you? Good opportunities for people to look at in the market?
You know, we, given the nature of our capital base and our investors and strategy, I'm afraid, and I wish we could have the luxury of pinpointing some specifics like Mark just did, because it's incredibly concise, and I think he's spot on with some of those trends. But in reality, I think we have to be a little bit more flexible with regards to our strategy. I can tell you that the one thing that we think about a lot is less about where the best returns are and more about where the greatest risk is. And I would just say that one thing that we have started seeing is a tremendous amount of capital flow into some of these new strategies related to alternatives, renewables, especially those with extremely long duration contracts that, you know, I'll never say that those are bond-like, but I think some investors think about those in that way. You know, we think a lot about that and whether or not risk is being mispriced in some of those strategies. And we've largely kind of changed our strategy, or at least paid attention to those dynamics as we're thinking about new alternatives. So I think that across the board, as we're thinking about the opportunity set, you know, we're just going to keep an eye on the best assets alongside the best sponsors that, you know, we partner with, and really approach the market in that way.
Cool. Adam, from your perspective, where do you see the best opportunities for investors right now?
Well, maybe just, Chris, keeping with the ESG theme, I think there's really sort of a short run and a medium run issues that we're dealing with. One is what I describe as sort of the moral imperative to deal with climate change. And how do investors deal with the moral imperative of climate change? And one say maybe it's I'm going to invest in a utility scale solar farm, and that's how I'm going to do that. Another way you can certainly do it, if you're concerned about climate change, is to invest in a fossil fuel company that is accretive on consumption today, not some point in the future. Right now, by backing an oil business that has a lower CO2 per barrel than average, you're doing something right now, and it's not speculative, and supporting that, and it's accretive today. So you are able to claim the moral high ground immediately. And I think that ends up being important, because that's, if you say you just want to do better than a half, that means half of oil and gas companies today are on their back foot. They got to do something about it. Half of global production should be starved of capital, and the other half, and increasingly as you get to the tail end, being better, should be given capital. So if you want a moral argument, that's the way to think about it, and you can do it today. The second issue, though, as for investors, which is really what Mark was alluding to, is, well, what does this curve look like for demand? When does it turn? Is it 2015? Or is it 20? Is it 15 years from now? Is it 20 years from now? Where is that point of inflection? And what thing happens at that point of inflection? Because that's what we're paid for. That's theoretically, why we make the big bucks, so to speak, is to look around the corner into the future and say, what's going to happen? Well, an easy way to deal with that issue is just make sure that you can get, and I think this is what Mark was alluding to, is if you've got a 15-year contract, make sure if there's nothing at the end of that, that was a good run. That worked out great. And I think that's is a healthy way to think about the industry. I think it's actually a very good discipline to think about the industry. One of the reasons the industry got into so much trouble is thinking that growth was going forever. And because growth was going forever, it got way overcapitalized. I actually like the idea of saying, I want to get all my return.
Sorry, Adam, we're running on time here. It's really good tips. I want to give John an opportunity as well to come in at the end here. John, because I think really good items from everyone. John, you go ahead.
Let me just build on what everyone was saying here, including what Adam was saying, which is to say, we think that some of the most interesting investments are going to be in that space where everything we think about is how do we move. ESG is not going away. The move to decarbonization is not going away. The question is, how do we do it profitably and sustainably? When I mean sustainably, I mean both environmentally and financially and economically. And I just think that you don't go where all the capital is. You go where the capital isn't and the opportunity is. And I think that's what others are saying here. We think a lot of that are in places where you don't have necessarily a zero strategy, but you have a low or in certain lower carbon lowering strategy. And a lot of that is going to take place in oil and gas, scope 1, scope 2 emissions, moving from diesel to gas, hydrogen, right? That chain there, for example, is one that we're very, very focused on.
That's super. I think as a summary, I think it's been a great discussion, great insights from people on the ground making those investments. I see this. I think overall the agreement is there's definitely a secular shift to alternatives, but there's a pathway for traditional, and there's often some secondary ESG type investments that Adam, Mark, John, Evan were alluding to, into that space where there are opportunities for return today, but this overall shift, and as you say, people are paying you guys to help them to guide through that and the timing of that. So I think that's excellent. I would say briefly, I did a similar panel 3 years ago in Boston, the SuperReturn Energy there. And when I raised a similar topic, I got blank looks from everyone. So in that 3 years, there's been a massive shift in opinion about the importance and significance of ESG and alternative investing. So I think that's positive for everyone.